Welcome back to another lesson at AllGen Academy. So we've been talking in previous lessons about different concepts that are important to understand when it comes to portfolio management, especially for the long term. And today we're going to talk about a fourth concept, and that's one that's created a little bit more controversy in the academic world and even in the professional world, and that's active versus passive investing. So Jason, the other concepts we talked about, diversification, rebalancing, asset allocation, things of that nature, dollar cost averaging, most people would agree these are good concepts to understand and to apply, right? Today we're going to talk about this concept, these two concepts, active investing versus passive investing or index investing, that not everyone agrees with one or the other, but it's important one to understand because you're going to hear them, and a lot of people make decisions on how to invest based on what they hear. Right. So let's jump into defining them first and then how these might be applied to investor situations.
Sure. So active investing is basically where the portfolio manager attempts to outperform a kind of the standard index or benchmark by being proactive in their investment decisions. So trying to buy when things are low, trying to sell when things are high, and trying to manage that process, reduce the risk, and trying to outperform the stock market. Index investing is a passive strategy where basically you're trying to replicate the stock market.
Right.
And so rather than trying to buy and sell, you're just particular stocks, you're trying to find better deals or anything like that. You're just saying, nope, I'm just going to own the market because the market has a great track record over time, and I'm going to do that through investing in like a mutual fund, an index mutual fund, or an ETF.
Right.
So,
which we explained what those were.
That's right.
An index again is an unmanaged pool or basket of stocks, bonds, of a security that are all similar in nature somehow. So you could have the S&P 500 index, which is an unmanaged basket of the largest 500 companies in the country, right? Yeah. Or you could have a bond index fund, which is a basket of bond funds. So gold index fund. So there's different types of unmanaged securities. That's what the index does. Why is there controversy amongst these, Jason? Why do some people feel, there's some people that say, no, you might as well just do index investing. We're going to talk about that. So let's talk about the advantages of disadvantages as we start explaining that.
Yeah, absolutely. So let's look a little bit deeper in index investing, and this has become a very popular one over the last 15 years. And the reason why that has been is because exchange traded funds, what's known as ETFs,
which we explained what they were.
Those funds really were only invented about 20 years ago, and a lot of them have started. There's been a lot more of those, and it's made it easier access to the stock market and different indexes for your average investor and for a portfolio manager in general. But the fees have come down a lot on those funds.
Right.
So, one of the biggest things about the difference between the two, and one of the biggest arguments you'll hear, is you got to lower your fees. You got to have the lowest fees as possible.
Right.
And they'll say that the stock that very few people or very few money managers over time. Some will even say no one has ever beat the stock market consistently over time. And so you might as well just accept that and just try to achieve what the market achieves, but lower your fees as much as possible in order to kind of reduce the drag on the portfolio. So the advantages of index investing is that you'll have usually good diversification if you own the right indexes, and not everyone does own the right indexes, but if you do, it gives you a really broad basket of different stocks and bonds if you own the right indexes.
Well, most people do is buy one index, which is the S&P 500. Right. Oh, I'm an index investor. Well, you're a one index investor.
That's exactly
not a good portfolio, diversification, that's everything we talked about in previous lessons.
And I think that's a good point because a lot of people think the S&P 500 is diversified, and yes, it is for large U.S. companies. It's got all different types of stocks in that one area, but what about small U.S. companies? Right. What about international? What about emerging market? What about bonds? What about gold? What about other alternative investments? That's not all in the S&P 500. So you'll have periods over time, like the last 10 years, for example, and this is 2020, where the S&P 500 has done much better than those other areas.
Right.
But in the prior 10-year period, those other areas did a lot better for the most part than the S&P 500. So
that's right.
The disadvantage of index investing is you won't beat the market because you're just trying to achieve the market returns minus a small fee, and you also take equal risk to the market, and not everyone can psychologically kind of overcome the different things that come along with big up moves and especially big down moves,
Right.
where they potentially may sell, after the market goes down a little bit. And if you do that in an index investing approach, you've messed up the entire approach. The whole idea with index investing is to, have a good diversified portfolio of different indexes and stay invested for the long term,
Right.
no matter what. Not try to time the
Put the
market.
blinders on and just let it ride.
That's right. And not everyone can do that.
That's right.
So one thing that's become really popular within index investing are what's called robo-advisors. And these are different investment advisory firms that provide cool tools, cool websites, cool apps, and things like that for you to be able to do index investing and to make it a little simpler for you to do that. The one issue, or the one thing I would say to be careful with those is a lot of them give you the ability to go more aggressive or more conservative.
Right.
And that takes away kind of from the index investing approach. You're becoming an active money manager if you're
Right.
trying to go conservative or go aggressive and trying to time the market. Just be careful with the motions that kind of take over if you're going to apply that index investing approach.
And essentially, because people tend to do that, again, because the emotional, and as you mentioned, they're in essence going away from the index investing mantra more towards an active investing, using their emotions. Now, there is some validity to active investing depending on who you are and who's doing it. So talk to us a little bit about the pros and cons of that.
Yeah, absolutely. And so, while one last thing about the index investing is the average investor, over time has been a lot of studies that when they try to time the market, they end up with inferior returns, significantly inferior returns. But the active investing, if it's done with a professional that has a good experience with a good track record, can have the ability to potentially earn greater returns and also reduce risk and volatility.
That's right.
So the advantage is, like I said, you could potentially have better returns than the market, and you can take less risk than the market. But the disadvantage is there's not a lot of advisors or professional money managers that do consistently do that over time. In fact, only about 20% of mutual funds, a study did, that actually beat their benchmark over a 10-year period. However, if let's say there's 10,000 different mutual funds out there, that means 2,000 funds did beat their.
That's
so
right.
if you could find a good active money manager who does a lot of research and finds those funds for you, or if you feel you're going to spend a lot of time and devotion to doing that, possibly you have the chance of outperforming the market and taking on less risk in the market.
That's exactly right.
The disadvantage is, it is, like I said, it's more difficult to outperform over time, but at the same time, there are potentially higher fees. And so whereas in the index investing approach, when you create an ETF or a mutual fund that is invested in, let's say, the S&P 500, that doesn't take much work for that investment money manager. They're just replicating the S&P 500.
That's right.
So they can really reduce the fees a lot. Whereas an active money manager or an active mutual fund, that does take a lot more work and skill. You have to find a lot. You're trying to find cheaper stocks. You're trying to find good deals. You're trying to find the winning sectors. You're trying to, study the markets to see if you should be more defensive or more aggressive. And so they sometimes will add, their fees will be a little bit higher.
Right.
Now, the important part to think about, and the important point to think about is your objective when managing money is not to have the lowest fees.
Right.
Your objective is have the greatest return with the least amount of risk after all fees.
Right.
Okay? So there are a lot of funds, there's 20% of funds out there that actually do have a better return after all fees. So, but the index investor out there and the firms who have all the index investing, they really talk about the fees. So everyone these days, it seems like, are just trying to reduce their fees as much as possible.
That's right.
But that's not your goal. Your goal is to have the best returns after all fees.
Yeah,
net fees.
a simple example, another example of real life. There's a reason why you have a Mitsubishi Mirage, which costs X amount of money. And then you have a Lexus, which costs considerably more money.
Right.
Okay, is one car better than the other? Well, in essence, the car isn't better. It'll take you from point A to point B, but how you get there is very different. So, you may have a smoother ride, a more luxurious experience, all that type of stuff, and for that, there's a price to pay, right?
Yeah, and you can even have more airbags or more safety. It can handle curves better. It has better braking. So there's some defensive measures within your car that may save you in an extreme scenario.
So at the end of the day, you pay more for that, but you see the value that you get for that, and the car would be the safety and all the measures. In a portfolio, hopefully it's better net return, you know, for the value that you pay for. Now, there's a study out there called the Dalbar study that shows that historically, you mentioned this before, individual investors that have tried to be active money managers have way underperformed, okay, what just the index has done, okay? So in that case, it probably would have been better for them just to put it in an index, okay? But that's the argument of why investors probably shouldn't be doing active investing. But when we talk about which is better, let's talk a little bit about that.
Yeah, so in our opinion, which is better, active or passive?
And we might sound biased here, and we are.
But I think if you're going to try to invest on your own, okay, and you're not going to use a professional money manager, professional advisor to do it, then I would say probably go with the index investing approach. You know, you have like the Vanguards of the world, you have different other companies that kind of focus on the index investing funds, keep your fees really low, be well diversified. My one pointer there is, like we said earlier, just owning the S&P 500 is not diversified.
That's right.
So if you go with an index investing approach, make sure you still are well diversified and then stick with it over time. Stay disciplined to that. But if you're a do-it-yourselfer and you're not going to devote your entire life to studying the stock market, then your index investing, we believe, is probably the better approach for you. It's a lot less risk and you tend to get better returns.
Right.
However, the active investing is better for those who are looking for potentially to have outperformance while reducing risk, or someone who doesn't have the time to study the markets or really the knowledge behind kind of trying to build a diversified portfolio. That would typically be better. Now, you want to make sure you do your research and find an active investor that does have a good track record.
Right.
But there's added benefits with having an advisor that you don't get when you're doing it on your own. And there's a study that was actually done by Vanguard that says having an advisor actually increased the returns by about 3% over time, on average every year over a long period of time, because of the behavioral side of it.
Right.
They were able to, you know, the investor was able to call up their advisor and say, hey, I'm really scared, elections are coming, or this is happening, or that is happening, and I think I want to sell out of the market. And the advisor was able to say, nope, traditionally or historically, you know, you'd be better off staying in, and they can kind of walk you off the ledge,
right,
you know, to keep you from selling maybe when the market was going down. And that provided a huge additional return over the long run, just being able to stay in the market. Right. So that's our kind of our thoughts on the two different approaches.
So at the end of the day, index investing versus active investing, which one is better depends. Okay, if you're going to do it yourself, go the index investing route. Understand that you need to put your blinders on, stick to the strategy, take the emotions out of it, and be willing to deal with the ups and downs of the index, which is a little bit higher risk possibility. If you're willing to hire someone to do it, okay, then if you can hire the right person, you'll find a person hopefully that can do some active investing, outperform the index, and hopefully get you to where you want to be with a little bit less risk involved. So thanks again for watching. We look forward to seeing you at the next lesson.